I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show.
Hey, Jim. Excuse my voice. I've got my annual Christmas cold this week, so I'll try to avoid coughing right in your ear.
John, right now we were talking off air about 3 mini bubbles are about to burst. Could you maybe explain what's going on there?
Yeah, this has been the first ever global financial bubble in which, almost everything has been inflated to levels that are, historically terrifying. And that's been because the center of the bubble is the fiat currencies of the world. All the major central banks have printing presses that they've been able to use to just increase the amount of currency in circulation and the amount of credit denominated in their given currency to levels that make no sense based on prior ideals of fundamental value in terms of, for instance, the bond market and now equity markets and real estate. So you've got mini bubbles blowing up on this stage everywhere. For instance, the U.S. auto market is a small but notable bubble with the way that we've been lending money to pretty much anybody to buy cars for longer and longer terms. U.S. housing isn't anything like the raging mania of the previous decade of the 2000s, but still, home prices in a lot of hot markets in the U.S. are at record levels. They're higher than they were in 2007, and affordability is worse than it has ever been in a lot of these markets. And meanwhile, you got China, which that illustrates what a gigantic bubble we are in globally now, when you can call China, which basically borrowed more money than any country has ever borrowed in the history of finance over the past 7 years, a mini bubble. It's not the big bubble. It's just one of many bubbles that are expanding and getting ready to pop around the world. Now, all three of those bubbles that I just mentioned are starting to pop, which is really interesting. You've got in U.S. housing, mortgage rates have gone up dramatically lately as overall interest rates have gone up. And the most recent pending home sales report was both surprising and really dramatically negative. Economists actually expected housing sales to continue to increase, even though mortgage rates were going up at a record pace. And it didn't work. People just stopped trying to buy houses that they could no longer afford because their mortgage costs were going through the roof. So housing sales have really dropped dramatically. Let that be the case for another few months, and we'll be in a housing recession. And it looks like it's probably going to be the case because interest rates in the U.S. aren't turning around; they're still going up. So housing, which has been a moderate growth driver for the U.S. economy, is starting to falter. And auto sales, which I mentioned before about how crazy the lending practices had gotten recently.
An 8 or 9 year car loan, well, halfway through the loan, the car definitely isn't worth what you paid for it. Do you see people just walking away and leaving their car in the middle of the street?
If things get really bad, yeah. But right now, you kind of need your car. And if you've contracted for, a car mortgage, let's say 7 years of payments, and you can't keep your car unless you make those payments, you'll try pretty hard to make those payments. But in the meantime, you'll cut back on other spending, so you won't contribute to the economy the way you would have otherwise, and you aren't going to go buy a new car if your current loan is underwater, which it is kind of almost by definition. When you borrow money to buy a new car, the minute you drive that car off the showroom floor, it drops in value by 30%, right? So you're instantly underwater, and then you've got to claw your way back up to even in years 6 and 7, if you're lucky, if you take great care of the car. So you're financially impaired from that day forward when you buy a new car on the current terms of car lending. And a growing number of Americans have done that, and we've been lending money to people with bad credit just because they were the only ones left to buy cars. And so we've kind of used up that segment of the market too, and interest rates are going up, so car loans are getting more and more expensive. That's leading the big car companies to do a lot of temporary plant shutdowns, which is a sign that inventory is out of control. In other words, they've got a ton of new cars sitting in big lots at their factories. Nobody's ordering them, so they're going to close the factories for a while and then allow that inventory to be worked off. But of course, if sales are going to fall from here, then that inventory is not going to be worked off at the rate they're hoping, and car plants are going to be closed longer, and car companies will make less money, their stocks will be less valuable, they'll have fewer people at work, so, auto workers will be spending less going forward. It's a factor in a slowing economy when the auto industry starts to scale back, and that's what we're seeing in the U.S. Now, China is a really interesting story because it's harder to figure out. U.S. housing and U.S. auto sales are kind of fairly straightforward stories. They're individual industries that have their own drivers and their own set of statistics, but China is this gigantic, opaque economy that's now the second biggest in the world, but is also, by some measures, the most highly leveraged. China borrowed all that money. They spend it unwisely on infrastructure that isn't generating anything like the cash flow that they need. And now, because U.S. interest rates are going up, that's causing the Chinese currency to fall in value relative to a relatively strong dollar. And that's causing huge amounts of cash to flow out of China. People who've made a ton of money over the past few years as China borrowed huge amounts of money and then misspent it. The people who have that money now are trying to get out of the country. And China is imposing capital controls to prevent money from leaving the country. So you've got the beginnings of a credit crisis there with no real way of predicting where it's going to go, because we don't know what's on the books of a lot of Chinese banks. They're very opaque. They don't tell us basically the truth about the loans they've made and how those loans are performing. So Western financial analysts don't have good information about what's going on in China, but the stuff that we can see is pretty scary. People are trying to get out, and the government's trying to prevent them, and that's something that frequently precedes something a lot more serious. And it also affects a lot of Western asset markets. For instance, Vancouver, has seen huge inflows of Chinese money. As rich Chinese were trying to buy Western real estate in order to get their money out of the country. Now, Vancouver has imposed some restrictions on what the Chinese can do in their real estate market, so that money has shifted down to Seattle, apparently, where $1 million plus Seattle homes are selling really well. But lots of other homes aren't selling really well. And if China succeeds in staunching the flow of terrified capital, then that's going to pull the rug out from under a lot of real estate markets and other asset markets where that money was flowing. So take these three together, and you've got the potential for global instability. Each of these problems in and of themselves probably wouldn't derail, the quote-unquote recovery that we've got going now, because there's just so much credit available otherwise. The central banks of the world are still printing money flat out, and they're still encouraging new lending. And the governments of the world are still running big deficits. So there's a huge fiscal and monetary wind at the back of the global economy right now. So even China having a financial crisis might not derail that process. But you take all three of these together, a slowdown in U.S. Auto sales, slowdown in U.S. real estate with prices dropping, and some kind of a credit crisis in China, and it's conceivable that that's enough to spread fear through the rest of the markets and cause something serious to happen. So 2017, from that point of view, is going to be really interesting because the three mini bubbles that we talked about today aren't the only things that could go wrong. They're just the things that are going wrong in this moment, and lots of other things could be follow-on problems if these guys actually, turn into serious problems in their own right. And one of the big ones is equity prices. U.S. stocks, and you mentioned before we went live that the FTSE in Great Britain is at all-time highs, and lots of other equity markets are really priced for perfection. In other words, continued low interest rates, continued steady growth, absolutely no geopolitical drama of any kind, and that's unlikely in the year ahead. So today, U.S. stocks are down really for the first time. They're down hard. Let's see, what do I have on the Dow here? 100 points down on the Dow. And that's the first time that they've been down like that in quite a while, in part because central banks of the world are buying equities so aggressively. They've brought a new era of calm to the stock markets, but at a cost of stocks going up to valuation levels that have historically preceded big crashes. So it's completely conceivable that we get an equity correction at some point in the not-too-distant future, and it could be caused by these other mini-bubbles bursting, but it could then contribute to instability in the meta-bubble, in the money bubble that's dominating global finance right now. So we've got a really interesting time ahead of us here when lots of things can combine to cause trouble that, as individual events, they wouldn't be able to. And I forgot to mention the Italian banking bailout that's ongoing right now. Italy's trying to bail out its oldest bank, and everybody's pulling their deposits out of the bank, which raises the cost of the bailout. So the price keeps going up, and the other Italian banks are in bad shape as well. So it's conceivable there too that becomes a crisis that is at least as big a deal as, U.S. auto sales or something like that, because it potentially destabilizes the Eurozone, which could potentially destabilize the whole global financial system. Jim, fascinating times, and, the only clear winner here is gold.
And we'll talk about that right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with John Rubino. John, you're saying the only thing that might come out here shinier and better is gold. Gold right now really lagging behind at around $1,140 an ounce. Is it going to bounce from here?
Well, gold had a brilliant first 6 months of 2016, and then has been in correction mode ever since. But based on one indicator that seems to have worked over and over again for the past decade, which is the Commitment of Traders reports, it's looking like a bottom is at least in sight now. Basically, the Commitment of Traders report, or the COT, is a snapshot of what the big players are doing in the futures contract market for gold. In other words, the big paper players. And when the speculators get overexcited in either direction, they tend to be wrong at the big turning points. So when you see them either going very, very long because they're so optimistic, or very, very short because they're so terrified, it usually means the opposite is going to happen. So what happened was in the early part of 2016 is the speculators saw gold going up, got very excited, went extremely long, and then set the stage for a big correction. Now we're seeing that play out, and the speculators are getting less and less long. Every week the COT report comes out showing the speculators closer and closer to balance. In other words, the point where their long positions and short positions are relatively the same. that usually precedes then a big recovery. Once the speculators decide gold isn't going up anymore and act on that premise, then it goes up. So we're getting to that point now. Maybe 1 or 2 more weeks like the last week, and that indicator will be back at a point that has historically preceded nice recoveries. So this is a decent time, based on that one indicator at least, to start looking at entry points. Where do you want to buy some more of either gold and silver themselves or the mining stocks that you think are interesting, and to maybe put some orders in. So, it's been a few depressing months here after 6 really energizing, exciting months in the gold and silver market, but it's cyclical. And the cycle is getting ready to turn, probably, in a way that'll make 2017 really interesting no matter what else is happening out there. If the global financial system starts to spin a bit out of control, and central banks and national governments have to aggressively liquefy the market, which is what they'll do. If there's any kind of trouble out there, they'll respond by pushing interest rates back down and by increasing money creation and by running bigger deficits. That's all they've got. And that's what they'll do when the time comes. So if that happens, if gold and silver are primed for a recovery at the same time that some major governments announce a ramp up in QE and a cut in interest rates, then that'll combine to make for a really nice run. And 2017 has the potential for something like that.
John, thank you so much for chatting with us. I know we're both struggling through minor health problems here, but I'm sure we'll be healthier, brighter, and wiser in the new year.
Oh, yeah. Another couple of days, you and I will be good as new, right, Jim?
Exactly.
Yeah.
Thank you so much, John.
Thanks. Take care.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Questions can be sent to info@HowStreet.com. I'm Jim Goddard. Happy New Year.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.